Good evening,
Progress.
everybody, and welcome to this month's monthly Market Insight call. This is the monthly webinar in which we will be discussing current happenings in the equity markets, try to cut through some of the clutter, some of the noise of news flow, economic data, valuations, and try to put some sort of a framework around it in a way that it becomes easier for you all as investors to understand and navigate. And as usual, every month we typically have one of our fund managers join us on this webinar to discuss the strategies he or she manages. And this month, I'm happy to have with me Ankit Agarwal, our fund manager who focuses on our mid cap strategy and also our small cap strategy. So this month, he'll be talking about the UTI mid cap fund. So that's going to be the structure of it. Now, the good and happy news is that we've already received quite a few questions from some of you, which have come in advance of this insight call. But do keep sending in your questions, and we'll try and take as many of them as we can at the end of the standard presentation. So what I'll try and do is run through my key comments in the next 20 minutes, and then Ankit will take another 20 minutes to run through his presentation, and then thereafter we'll keep it open for Q&A, including the questions which have already come in. So very quickly, let's dive in straight away. And this is, of course, something that all of you are very, very familiar with. There's been a lot of newsprint. It's been all over the media, which is to say that when the data is now coming in for the forecast for calendar 22, the current year, it looks like India has now clearly overtaken the United Kingdom and become the world's fifth largest economy in terms of GDP. With a GDP of about $3.5 trillion, we are now the fifth largest economy in the world. Of course, when you think about this in per capita income terms, there is still a very long way to go, because when you think about India's population, approximately at about 1.25 billion population, then we are talking about a per capita income of barely around $2,500, $2,700, as compared to what would be considered middle income territory, which is closer to about $15,000. So we have a long way to go in terms of raising the income of our citizens. But at an aggregate basis, we are now the fifth largest economy. Now, I know there's been a lot of discussion about this. It's a matter of great pride that we've achieved what we have. But could this have been foreseen, that this might be in the realm of something that is possible? And what I have over here is a report which was published by a well-known investment bank, Goldman Sachs, which in 2003. And the report is titled Dreaming with Bricks 2003. And what this report essentially did in 2003 is that it indicated the point of times at which economies were likely to, grow and become larger than other economies. Now, very interestingly, as you will see over here, an economy like China has grown in size and reached that almost a 16 trillion plus dollar mark, well ahead of schedule. And if you look at current forecasts, more forecasts which are being published today suggest that China may match the US economy in terms of size somewhere between 2035 and 2040. And interestingly, that is very much in line with the forecast which was made in 2003. Similarly, if you look at this chart over here, what you will notice is that as per this trajectory, which was charted in 2003, India would become as large as Japan sometime in 2030-2035 period. And if you look at current numbers, it would very much appear within the realm of possibility that by the time you get to 2030, 2030, India would be on track to overtake Japan, and becomes the world's third largest economy after US and China. Now, if you look at the remaining countries over there, Russia and Brazil, in a sense, they have stumbled relative to those targets for reasons that we won't go into. But I think this just provides a bigger perspective of how a longer term structural trend can play out. And, almost 20 years after this report was written, it does appear that at least two of the countries have more or less delivered on the potential that was considered possible in 2003, whereas two others have disappointed, which also tells you another point, which is that essentially potential is important, but execution is even more important if you really want to get to your destination. The final point on this chart was that the four BRIC economies, which is Brazil, India, Russia, and China, would become as large as the G6 by late 2040. And it does look like, again, this target might be achieved on schedule or maybe even slightly ahead of schedule. But of course, that's a function of how the two weaker economies among the BRIC economies eventually performs. So I just thought I'd open with this to give a bigger picture that it's a momentous year in which we are now become the world's fifth largest economy. Could this have been envisaged? Absolutely. 20 years ago, this was the forecast, and it's good to see that it's coming true, at least for two of the four countries in that BRIC report published in 2003. So moving on from that, I think one of the things that I've seen a lot of conversation about, which is India being placed on a very strong wicket relative to the rest of the world. Now, I would more or less agree with this, sort of contention or this argument that India is very favorably placed, or at least it has emerged from the COVID pandemic in a situation of relative strength compared to other economies. But it's important to remember that when you actually go back and look at the metrics like to like, December 19 vis-a-vis December 22, for the latest available data that we have, it is clear that, not all parameters are looking great. For example, you look at inflation, we are running 200 basis points or more higher than where we were in December 2019. We look at the RBI repo rate, significantly higher. On the bright side, industrial growth, running better than where we were in December 2019. Credit growth at 17%, maybe slightly hotter than what we would like. In fact, that's perhaps one of the things that RBI would be tracking, even as it tries to, tackle that higher level of inflation. Credit growth is actually much hotter than one would like. And I think you will see some settling down of credit growth because some part of it is base effect. But, certainly that's a number that the RBI will be watching closely. The 10-year GSEC rate as well, almost 80 basis points higher than where we were in December 2019. Some of the more worrying parameters are at the bottom. If you look at the fiscal deficit for the current year, 6.4% as compared to December 19, when the forecast for March 20 was 3.8%. Now, I know there's been a delay in any sort of fiscal consolidation because of the pandemic, but it's important to remember this, that we are not in as good fiscal shape as we were in 2019, and the target that we now talk about of getting down to about 4.5% in December in FY26 would still leave us at a fiscal deficit higher than where we were in December 2019. And that's really the impact that the pandemic has had in terms of being a setback to economies across the world. Next, you look at government debt to GDP. From 75%, it's up to almost 87% in India. So again, that's a matter of concern, because once you go above 90%, we do know that there is historical evidence that it can start to create its own set of problems. Also, current account deficit, which was at 1.5% this year, running at 3.9%. Some part of this is attributable to the conflict in Russia, Ukraine, and as crude prices settle down, there's every reason to believe that this number should start to trend lower. But, does it really get back to the 2% comfort zone of the central bank? That's something that we'll have to continue to monitor. Nominal GDP, headline, up by almost 20, odd percent, 18% actually over the period from, December 19 to December 22. These are nominal GDP numbers up 24%. So just to make a quick point over here, remember that these are actually nominal numbers. So the impact of inflation is not visible in this. Once you adjust for inflation, the real growth in GDP will be much lower. Once you adjust it for the fall in the US dollar, it comes down even lower. And once you switch to per capita, the actual growth in incomes over this 3-year period for the average Indian basically works out to a number somewhere between 1 and 2%. So, that 10-12% nominal GDP growth turns into a very marginal real income growth for the Indian citizen. So it's a good outcome because we are much bigger, but in real terms, the income growth has been marginal. So that's why I say, India is really the cleanest shirt in the laundry. Everybody has problems. That's why they are in the laundry. Every shirt is in the laundry. It's just that our shirt is slightly better than the others. But, there is clearly damage from the pandemic that every country has, certainly experienced. So we move on from this to take a quick look at what's happening in policy rates across the world. And you can see the sharp drop in the policy rates of developed economies going into the pandemic. India doesn't come down as much. And then you can see the very sharp hikes which start to happen, particularly in developed market economies. And this is what is leading to increasing concerns about a potential recession in the US in the next financial year, but we'll talk about that later. If we move on to the next slide, this just gives you a sense of what has happened to yields in India. These are the yields in December 21, the dark line, as compared to November 22. And you can see at the shorter end of the curve, there has been an increase in yields of almost 250 basis points. But once you go out towards the 10-year period, the increase is much smaller. It's in the region of about 80 to 90 basis points is the increase in yield. And the yield curve has flattened, which does start to give some comfort that maybe we are hopefully at the tail end of the tightening cycle. Moving on from that to take a quick look at where we are in terms of valuations. Now you can look at this detailed data on the right later. The only point I wanted to make is on the left hand side, which is the P of the MSCI India and the P of MSCI Emerging Market Index. And you can see that over the last 1.5 years, the black line, which is the EM index, has gone down quite significantly, whereas India, which is the red line, has more or less stayed expensive during this period. And therefore, the premium, which is indicated by the green shading, has actually increased quite a bit. And I think this is one thing which sort of makes India's valuation attractiveness slightly dimmer as compared to other parts of the world, even though on a structural basis, when you think about longer term growth outcomes, it could very well be the case that India actually has the best potential for structural growth over the medium to long term. But, the question really is that already fully captured in the valuations? So very quick look, we'll go on to the next slide. This is the regular roundup of the equity markets. And I'll just point to that, 1 month outlook that you can see over there on the left-hand side, which is you can see with the slight change in messaging, or at least the market sensing of a change in messaging. Some of the more beaten down markets have rallied strongly. Hong Kong up 26%, China up 9% in November. India did well, but relatively more muted. And to my mind, that sort of indicates the pain trade, which is what people have tried to participate in. And I think if you look at the current month data as well, some of those beaten down markets like China, etc., continue to do very well, simply because they had become very, very cheap. But, I think the longer term structural stories like India on a 1-year basis have clearly outperformed the pain that has been experienced in the other markets. Moving on from this to look at the regular valuation picture. You can see the valuation picture on this slide. I won't spend too much time on it, but just to make the simple point that when you look at earnings growth, 22 is a record year, but there is a significant earnings slowdown in 23, impact perhaps of the margin cuts we have seen. So only about 10% earnings growth expected in 23, and then earnings expected to rise again the next year by about 18%. Where does this put us in terms of earnings trajectory? You can see on the next slide. You can see in the next slide there are slight cuts coming through in earnings. Look at the right hand side. That shows you the drop in earnings forecast for 23 and for 24. So if you look from April to now, there is a gentle downward trajectory which is visible in the earnings. In terms of valuations, you can jump to the next slide now. This shows you the Nifty trailing and the forward PE. Left-hand side trailing PE is still in the comfort zone, but forward PE now back in the expensive zone. It's above the red line and well above the yellow line, which is the long-term average. Ignoring the volatility in earnings, if you look at price to book, you can see that on the next slide. On the left-hand side is the price to book, and you can see over there it's more or less now reached the red zone, which is the expensive zone. So valuations not really giving too much comfort anymore. Return on equity is significantly superior. This is pretty much the best ROE we have seen in 10 years. So it does sort of make the case for superior price to books. But, when I look at all three metrics put together, there is some kind of valuation discomfort in the market today as compared to where we were in June, which you can see in this slide. In June, actually, the price to book had dropped below the long-term average. Where are we in small caps and mid cap valuations? You can see that on the next slide. Mid caps on trailing still in the comfort zone. Small caps on a trailing basis still trading quite rich on the price to book ratio. So again, I would say, if I were to sum this up, large caps have some richness associated with them. Nifty mid cap rich, but sort of same comfort zone like large caps, but small caps is where valuations still seem quite pricey. They're still trading in the rich zone very clearly on a price to book basis. If we jump to the next slide, this shows you the picture of the 10-year yield for the GSEC vis-a-vis the Nifty yield. The Nifty yield is nothing but 100 divided by the PE multiple. This difference is currently at almost 2.17%. This is more or less one of the worst numbers we have seen in recent times, which actually makes the argument favorable to buy long-term bonds as compared to equities. So if you were to do an inter-asset class framework, the framework is currently tilting favorably towards long-term bonds. So I'll jump now to the next slide, which is sort of the can we get the next slide? Yeah. So this is pretty much it. The sort of summation of everything we've discussed so far. The US Fed funds rate forecast to rise to 5%. Significant probability of a recession in the US. In China, the good news is that there is some moderation in the zero COVID approach. There are signs of policy accommodation. The dollar has given back a large part of its gains year to date. It's now up only 10%. At the peak, it was up 20%. Commodity prices are down. Shipping freight rates are down, increasingly indicating concerns over the outlook for global growth. In fact, if you look at crude oil, the WTI, which is the US crude benchmark, is back to pre-COVID, pre-Ukraine conflict levels. And as we speak today, even the Brent crude prices are now only marginally above the price that they were before the conflict broke out. So most of those war-related disruption gains have now gone. In India, the peak policy rate forecast based on what the swap markets are telling us appears to be about 6.5%. Our macroeconomic parameters are in much better shape, but the focus is now on fiscal consolidation and management of the CAD. Earnings estimates have continued to drift lower for FY23, but are stable for FY24, only marginal cuts. Equity valuations above the long-term average, in fact, close to the rich territory. Bonds appear attractive related to equities, and investors should adopt a continued staggered approach towards equity and review your asset allocation in case portfolios have moved away from the targeted asset allocation pattern. So that's about a wrap in terms of what I wanted to cover on this insight call. And I'll pause over here. I'll be coming back later to tackle some of the questions that you all have sent in. But I'll hand over now to Ankit, and he's going to talk about our mid-cap fund and how he manages the mid-cap and our small-cap fund, and both the similarities as well as the differences in the strategies that he runs. So over to Ankit.
Thanks, Vetri. Thanks a lot, everyone, for joining this webinar. I will be talking about the mid-cap and the small-cap fund and our investment approach that we have in this fund. Yeah, next slide. Yeah, so I mean, if I very broadly, if I have to sort of look at a long-term strategy, the focus in the both mid-cap and the small-cap fund is to invest a large part of a portfolio, close to 60 to 70% of the portfolio, into businesses which have a long runway of growth. And what we are looking for are companies which are market leaders in the space that they operate in, have demonstrated a consistent track record of profitable volume growth, generate high returns on invested capital, so that the businesses can reinvest that capital and continue to compound their earnings over a period of time. Most of the companies will be run by good quality managements with good track record of governance, and they would basically focus a lot more on balance sheet, generate high operating cash flows, and be able to compound their earnings over a period of time. So you're looking for businesses which are scalable and have operate in industries which have a long runway of growth. So a large part of our portfolio is sort of aligned in those sort of businesses, and we call some of these and what we'll see in the later part of the presentation also what we call large cap isotopes. We also invest a smaller part of the portfolio, around 30% of the portfolio, in what we call turnaround and transformational business. A turnaround business is basically a good could be market leader in the space they operate in, but the business might be going through a weak operating phase, and that could be because maybe the macro is not favorable, or that business might be going through a bad cycle, and therefore you're focusing on businesses which are more undervalued at this point in time. And as the cycle reverts, you'll not only see benefit of earnings going up, but also valuations mean reverting, and therefore you will get benefit of both earnings growth and also valuations coming around. And therefore, those become part of this turnaround strategy. And transformational change is basically we invest in businesses which are going through some transformational change within the business. It could be that there is a change in management, or the sector might be going through a structural re-rating, which or a structural change which could potentially lead to re-rating of candidates within that sector. And therefore, that becomes a much smaller subset of the turnaround strategy, because such businesses will be more difficult to identify. So that remains the core of the strategy within both the mid cap and the small cap fund. So therefore, we are focusing on not only wealth creation, but also sort of complementing that with some value opportunities also. Next. Yeah. So a little bit about the mid-cap space itself. So if you look at long-term, and we looked at long-term returns of both Nifty 100, mid-cap 150, and Nifty small-cap index, one interesting thing that we find is that on a risk-adjusted basis, actually the Nifty mid-cap 150 does much better than both the Nifty 100 and in fact, surprisingly, from the small cap space also. And therefore, on a purely index basis, actually the mid cap strategy does really well on in the long term, and you get compensated for the risk that you take in that index. As far as the small cap index is concerned, because the index is probably not as well constructed, it has some poor quality businesses which are fairly volatile. What we see is in the medium to long term, they not only not perform as per expectation, but also they do not compensate you well for the risk that you're taking in the particular strategy. So from a small cap perspective, you have to be a lot more focusing on stock selection as opposed to both the mid and the large cap space. Next. So, what I mentioned in the earlier part of our presentation, that we like to invest in what we call large cap isotopes. So a lot of times you get questions whether, whether one should invest in large caps or mid caps, because, mid caps could be more volatile. But the way we think about mid caps is you could actually identify companies in the mid cap space which are actually leaders in the space that they operate in. It may be so that the sector in which they are operating, that sector may be much smaller today, and therefore it may not have enough representation in the large cap space. But these companies have very similar characteristics to any large cap, which means that they are a leaders in the space they operate in, run by good quality management, professional management, good quality balance sheets, access to capital. So all the factors which reduce volatility in businesses as far as large caps are concerned, the same factors are now available in the mid cap space also. And because these companies are operating in smaller sectors, smaller niches, their growth trajectory is much larger, and therefore you not only get benefit of some amount of stability as compared to large cap, but also you do get growth in the medium to long term. So that's so we do like to sort of invest in what we call large cap isotopes, which invest in leaders in their own right, and we can sort of see some portfolio snapshot of our top holdings, and most of these companies are leaders of in the space they operate in. Next. Yeah. So now we'll talk very briefly about the small cap universe. And in the earlier part of the presentation, when we sort of saw that the Nifty small cap index is doesn't perform so well as compared to the mid cap and the large cap, one might think as to why should then one look at the Nifty small cap space or the small cap space altogether. So the reason why you might want to look at the small cap universe is that it may give you an exposure to sectors which may not have enough representation, especially in the large cap, but maybe also in the mid cap space. So for example, some of the opportunities which you will find maybe on the chemical space, or maybe on the healthcare space, or on the cap goods space, some of those opportunities may not be there, or may not have adequate representation in the large cap space, and some of the emerging sectors may actually come from the small cap universe. So therefore, looking at the small cap space purely from an sector diversification perspective actually makes a lot of sense. The next slide. But I think what becomes very important, and this is also from a fact that a lot of the opportunities in the small cap space are under research and under owned, and therefore a strong investment process and having a strong research becomes very important, because your task actually becomes more about excluding poor quality businesses. And if you are able to do that, you automatically, so the good quality businesses will end up making alpha for you in the medium to long term. And therefore, going with a large house like UTI, which has an established investment process and an experienced research team, actually helps you cover small caps where, anyways, the institutional ownership may not be very high, or analyst coverage may not be high. And therefore, our 364 universe of, companies, with a fairly large coverage of small cap companies gives us an ample universe of stocks which one can use to invest in the small cap space. Yeah, right. Yeah, so that's it from my side. Over to you, Niranjan.
Thanks a lot, Ankit, for that overview on UTI Mid Cap Fund and UTI Small Cap Fund. Like Vetri mentioned, we have already received a few questions, and that we will take it in here. And also request participants to keep posting your questions. While we have got many questions, any more questions, we'll be happy to take them in the next 20-25 minutes or so. Yeah, the first question to you, Ankit. It goes on like this. This is a question, in fact, also coming from the participant who is also online, Mr. Rajiv. In the current environment, given the inflation and rising interest rate concerns, do you think the mid caps are more vulnerable than the large cap stocks?
Yeah. No, in fact, we get this question a lot, and I'll just go back to our sort of previous discussion on what we call large cap isotope. So very similar to large caps. So we do not really distinguish between businesses on purely market capitalization perspective, but rather look at the quality of the business. And what is the quality of the business, and that is what actually defines how vulnerable they are to market or sort of macroeconomic variables. And therefore, if you are investing in companies which are leaders in the space they operate in, which have well-managed balance sheets, run by good quality managements that focus on proper capital allocation, who focus on generating higher returns on invested capital, automatically these businesses have a lot less volatility, and therefore they are able to sort of face the impact of inflation. They have pricing power and interest rate concerns much better, and therefore they act very much like what a large cap company would act in such a scenario. So we try to have a significant proportion of our portfolio in these large cap isotope companies, so that in times of such volatile macro environment, they are able to sort of weather that volatility much better, and therefore emerge stronger from such risks. And that's remain a key focus in the mid cap strategy.
Sure, Ankit. Thanks a lot for that. This is a question to Vetri, to you. The question is like this. Relative performance of Indian equities as compared to global markets continues to be solid in current calendar year. Will this likely to sustain in coming year as well?
I think that's a very good question. And, just to make the point which I covered in some of my slides earlier, India's relative economic picture is much better than what some of the other EMs are experiencing. And that's one reason why India's market has done far better. Of course, there are others who have done well. Countries like Indonesia have also done well, both in the equity market as well as the bond market and currency market. Same would also hold for Brazil. So India is not an exception, but it's one of the few countries where, because of this favorable structural story combined with, navigation of COVID and exit from COVID reasonably well, markets have held up better. But I think for this relative performance to sustain in CY23, there are two things we need to keep in mind. One is from a premium point of view. If you remember the chart that I had used earlier, India is trading at a very significant premium to the rest of the EM basket. And therefore, that makes it difficult for the market to deliver performance on an absolute basis. On a relative basis, it may, but on an absolute basis, I think that's a challenge. And I also think, we looked at that data of which markets did well in November, and you notice over there that some of the more beaten down markets actually had the bigger bounce. And I think there is a bit of a story in that, which is to say that in case growth were to actually sort of, recover either in China or for that matter, it were to be a shallow recession in the US, then, money is likely to go chasing those markets where the sell-off has been very deep, where valuations are cheaper, and where there is potential for a cyclical bounce. So I think that's the only set of circumstances in which India may find it difficult to perform. But we are talking then about a very short period of time, right? I mean, what's the context in which one should think about the strong performance of China or Hong Kong in November on a 1 year basis, on a 3 year basis, 5 year basis? Indian equities are still doing well. So, the larger point I would make in response to this question is that I think if you're thinking about Indian equities over the medium to long term, there is reason to believe we can support strong relative performance. Stagger your investments, keeping in mind current valuations. But in case there is a cyclical bounce in the markets, then Indian markets may actually underperform other parts of the world because you're already priced well for a structural growth story. But if somebody is looking to play a cyclical bounce, a cyclical recovery, then there are other beaten down markets where you will be able to play it far better. So I think those are the two ways to think about the answer to this question.
Thanks, Vetri. So one last question before we move on to the live questions. And this is a question to you, Ankit. Flows in particularly the small cap category are very strong in the recent past. How do you view the valuation in the small cap stocks today, and what are the risks in the small cap stocks?
Yeah. No, so that's fairly correct that, value, as we saw in the earlier part of the presentation, if you look at it from price to book perspective, the valuations of the small cap index are trading close in that expensive zone, and therefore they are slightly more expensive at this point in time. I think the other point that we made in the presentation was if you look at the construct of the small cap index, it doesn't, on its own, it doesn't give confidence to generate returns on a risk-adjusted basis. So the long-term track record of the particular index isn't that great. And that is because probably the index has a lot of poor quality businesses which have significantly high volatility over the medium to long term, and therefore the index tends to underperform the large cap and the mid cap index on a risk adjusted basis. I think that's where your investment team and your research capabilities come into play, because actually the fund objective therefore becomes all about weeding out these poor quality businesses, so that what you're left with then are good quality businesses, which again can create that benefit of compounding over the medium to long term. So I think the risk in the small cap space comes more from selecting poor quality businesses, and therefore that's where one needs to sort of be a little bit more careful when selecting stocks. Also, impact costs, and since volatility in this space is very high, the impact costs of in getting in and out of businesses is also on the higher side, and therefore you also need to be able to manage position sizing, etc., considering the liquidity in the space also well. So that is another risk that one should be mindful of beyond the fundamental risks of investing in this space.
Thanks, Ankit, for that. We will now move on to the online questions. There is one question coming from Mr. Prerak and also Mr. Arjun. His question is primarily, question goes like this: what are the sectors or companies which are part of the turnaround and the transformational changes in the mid and small cap portfolio? So if you can just elaborate on that piece. And also Mr. Arjun's question is, what is your view on this fund, UTI mid and small cap fund, vis-a-vis the momentum index?
Sure. So I think as far as I understand, the first question is about some examples on the transformational space.
Right.
Yeah. No, so I mean, I think this could be anything with respect to a management change, which leads to the operating performance of the business significantly improving. So just to give you an example, something like a Tube Investments in the portfolio could be a case of a transformational change where you saw a change in management, which then drove significant improvement in operating efficiency, and therefore, created that structural re-rating that we saw. Or it could be, something on the green energy space, where we are seeing a lot of, play in the ethanol blending space, where a lot of the cap goods players in that space, benefited because, there was significant push from the government on the blending program, and therefore led to the players in that space seeing a significant re-rating. So, some of those examples where, either there is a change in maybe management, or which leads to a transformation of the business, or it could be maybe sector related change, which structurally changes the way, that business makes money, or the ROICs of that business, then can cause structural re-rating. I think on the second question was on comparison with the momentum index. So I think, see, our strategy in case of small cap, and which is the same in case of mid cap, is to find businesses which are good quality companies, which can compound earnings over a period of time, and are in sectors which have, say, sort of long runway of growth. And therefore, we have a very buy and hold thinking when it comes to this part of the portfolio. So I don't think we chase momentum in any way when we are looking at these stocks. Because at the end of the day, you can only get that benefit of compounding if you hold the stock for a fairly long period of time. And as we realize in the small cap space, once you identify a good business, you want to hold on to it. Because good businesses and good managements remain good businesses in the foreseeable future also. And therefore, we do not, chase momentum in that part of the strategy.
Thanks, Ankit. Vetri, this is a question to you. If the growth is set to stay low, does that call for fundamental reset at fiscal level, and also as the MPC hit the dead end of the rate cycle hikes?
Sure. So, I think if you look at even the RBI forecast, remember RBI gives a forecast for, the next 4 quarters as it sees it. The growth estimates from RBI would suggest that we are at a 6.5% growth trajectory for FY24. If I look at the Bloomberg consensus for FY24 GDP growth estimates, they are just about the 6% mark. So there will be some, sort of moderation in growth. But, I think from India's point of view, the sort of growth rates one can expect or hope for under the current set of circumstances, 6 to 7%, given what's happening in the rest of the world, I think it's still a reasonably good outcome. I think very clearly the MPC is, indicating, and even if you look at the split in their vote, it does suggest that the MPC feels it is near the end of its rate tightening cycle. But they have also indicated that, they would like the corridor between inflation and the policy rate to be at least about 100 basis points. And remember, our target rate for inflation is 4% plus or minus 2%. So we are right now above the ceiling rate. So we first need to allow rates to drop back to below 6%. 4% the RBI governor indicated is their final sort of target rate, but it at least needs to come back below 6. So under those circumstances, I think what the swap market is pricing in, which is a terminal rate of about 6.5, does seem that we are near the end of that journey. One critical thing to keep in mind, even when we saw that, chart in terms of the behavior of central bank policy in other parts of the world, is that there are no signs at this point of time that India is facing significant labor-led, pricing pressures. This is unlike the US, where we know that there is a problem on labor supply. So I do think that therefore, the outlook for inflation in India is slightly more sanguine, but equally, I do think rates will sort of remain at this level for a while, because certainly the MPC would like to see inflation come back within its comfort zone of 4 plus or minus 2%. And I think that will take some time. So more like we go up and we stay at a plateau for a while, which is not a bad outcome from a growth perspective.
Thanks, Vetri. The next question is to you again. So, in fact, in your deliberation, you did mention about the sell-off which happened since October 21, and we have seen some sort of reversal there. While that's been the trend, so in this phase, growth stocks or high ROC stocks had the major sale volume hurting their valuations. So, is it a matter of concern, and could this reverse sooner rather than later?
Sure. So absolutely right. The last 1 year has been very bad for what I would call quality growth. If you look at the behavior of the NSE indices has a quality index. They don't have a quality growth index, but it is a reasonable correlation with quality growth. So quality growth has certainly underperformed, and that's because of this very sharp rise which has happened in the policy rates, particularly in the US. But I do think that, even over there, you are now closer to the end of the cycle. Now, it may be a plateau. It may not necessarily see rates collapsing back to that zero bound level that we saw for so many years. But I think once there is a lot more stability in that interest rate outlook, then we can sort of look at a market which starts to become more steady. Also, I think, in a sense, the value trade got a second leg from what happened in Russia, Ukraine at the start of this year. It increasingly looks like that part of the value trade is coming to an end. It's very hard to predict when value and growth sort of take the lead in terms of performance. So I think what I would always say is that from an investor point of view, think about value and growth as tools to diversify your equity allocation rather than as a timing tool, because these timing cycles, they can be very rapid and they can change at very unexpected moments. So can you time it perfectly? The answer is no, but you can use growth and value as tools to quality and growth versus value as tools to diversify your portfolio, and that's what I would recommend investors should do.
All right, thanks for that. There are quite a few questions which have come at the sectoral level. Before we move in there, so one question on the fund, the strategy, UTI mid cap and small cap. So the question is, Ankit, like this: what is the strategy followed for portfolio churn in UTI mid cap and small cap fund? And also the second question is, what are the risk mitigating strategies adopted in these funds?
Sure. Yeah, so I think the strategy both within the UTI mid cap and the small cap is to, have a large part of the portfolio as a more buy and hold. And the reason for that is that, once you have identified a good quality business run by good management, then you want to hold on to that business because, we have realized over a period of time that to be able to identify such businesses is very difficult. And therefore, once you have, identified a good business which generates high returns on invested capital and has a long runway of growth, you want to hold on to it. And therefore, we do, want to have a largely buy and hold strategy. I think the part of the portfolio which is on more turnaround strategy, there, if, once a turnaround has played out and once the, valuations have become sort of have recovered or mean reverted, maybe there you would want to do some profit booking and therefore the churn in that bit of the portfolio may be a little bit on the higher side. But overall, if you see, we do run both the portfolios at a relatively lower churn as compared to industry, and that's largely because a big chunk of the portfolio, which is driven by more high, good quality businesses with long runway of growth, there we have a largely buy and hold approach. As far as the risk mitigating, steps that we do see, so one of the 2-3 risks which you have are like stock specific risk, which we call idiosyncratic risk. These you sort of try to diversify or try to mitigate them by having a much more diversified portfolio. And therefore, because you are running a strategy which can get inflows in and out, running it with a more diversified strategy makes a lot more sense because you do not want to take any stock specific or sector specific exposure, significant exposures in that strategy. Secondly, we are quite aware of the liquidity related risks which are there in this mid cap and the small cap space. And therefore, this diversification also helps you to mitigate any impact costs that you will incur if at all you have to exit any stock, or in fact, even when you're making an entry into the stock. So, having a more diversified, having, stock specific limits, sector specific limits, and being aware of liquidity when you're building in positions, I think those are some of the steps that we take to mitigate some of the other non-fundamental risks which may occur in the small and mid-cap space.
Thanks, Ankit, for sharing such thoughts. There is a question on the PSU bank sector, so probably you can take this question again. So this is coming from Mr. Deepen Kumar Shah. So PSU banks have performed well in the recent past. Does UTI Midcap Fund has any exposure in this space, and your stance in this sector?
No, so we do not have any on the we do not have any exposure in the PSU midcap banking space. Our take there was simple that if you see it across the cycle, then we have seen some of these PSU banks underperform on asset quality, and we also lose market share to some of the private owned entities. But in our sort of the whole turnaround part of the portfolio, we had exposure to some old private sector banks where we believe that the management quality was much better, and they did have a business case for high ROAs because they cater to the SME space. So I think some of those exposures have done really well for us, while we didn't hold any exposure in the PSU mid-cap banking space. And our stance, would remain the same. That if at all I have to play the valuation catch up and credit cost normalization, I would rather play it through some of the old gen private sector banks, where again the valuations are similar to some of these PSU banks, but they do have a business case in terms of high ROAs when you look at their business mix. So I mean that's our take on the PSU banks. Yeah.
Sure, Ankit, thanks. In the interest of time, maybe we will take next 2 or 3 questions. Vetri, this is a question to you coming from Mr. Gautam Chatterjee and also Ms. Radha. So while Indian market is at a premium valuation, are there any sector level opportunities that investors can benefit from now on with healthy return expectations for over the next couple of years?
So the way I think about this is that you can only identify where there is a degree of valuation comfort. What happens in terms of returns is something where you have to presume that if the valuations are in your favor, then it creates the kind of setup for a favorable outcome, but it doesn't guarantee them. But if you think about where the valuations currently appear to be still sort of favorable, where the markets and the stocks have maybe underperformed and derated, I think clearly one area which stands out is, I would say, a large part of the pharmaceutical and healthcare segment. I think many stocks in this area have underperformed. The sector itself has underperformed, and as a result of that, we are seeing valuations which look far more comfortable, and therefore the embedded growth expectations in the stock prices are a lot more reasonable. So that would clearly be one area. Some of the others actually require you to be slightly more contrarian. To the extent that there is a great degree of confidence in stock prices reflected in the valuations that you see for stocks which are domestic oriented growth stories. Actually, if you want to look for where the valuations may be slightly more comforting, despite concerns about what is the current growth outlook globally, you have to look for those stocks which are externally exposed. So to my mind, the external facing sectors, including perhaps some of the businesses which are facing towards Europe, are the kind of rummage in which you want to be sort of looking around to see, is there a business or two which can really come out of it. But really, therefore, it's more about stock picking within sectors rather than necessarily a sectoral bet. Having said that, I also think that 1 year ago maybe IT was massively priced relative to growth, the embedded growth expectations. It was at a premium to the long-term average. IT has still not corrected back to long-term average, but it's somewhere back in the comfort zone. And, from here onwards, I would be more inclined into any poor news and IT to actually start looking for good opportunities bottom up in that sector, because I think some degree of the valuation correction there has played out. So if you want to be contrarian, I think this is a time to be looking for businesses that look like they can survive and eventually thrive once some of these clouds and fog related to global growth start to dissipate.
Thanks, Vetri, for the insight. Ankit, there is a question to you. This is on the mid-cap as a category's performance vis-a-vis the index. So as we have seen relative underperformance of the actively managed mid-cap funds vis-a-vis the benchmark. So what is your view on the near-term underperformance? What is causing the underperformance? And also, what's your outlook in terms of the alpha that these funds can generate over a period of time?
Yeah. No, I think in the like we already discussed, quality growth has sort of underperformed in the last 1.5 years, and that's largely because we have seen this sharp rise in interest rates, which has caused some of the valuation multiples sort of to derate. And because our portfolio is a lot more still tilted towards more growth quality, it has seen some underperformance in the last 1 year. So I think I would say that we'll stick to our investment strategy, and as long as we understand what we are sort of playing with, I think more or less performance of growth versus quality the cycle can revert, and you'll see some of the quality focused funds to do well. So I think that's all I would say on why the fund has sort of underperformed in the last 1 year.
Thanks, Ankit. There is a follow-up question also. As there has been a good rally in some of the cyclical opportunities from utility power sectors, is this rally likely to continue? And what are the red flags which you look for before investing in such high beta stocks?
So let me, instead of calling them out as high beta, I think what we can say is that, whether it's a cyclical business or non-cyclical business, and typically, when you're looking at cyclical businesses, you need to invest in those cyclical businesses when they are going through a bad cycle. Because when they're going through a bad cycle, one, their valuation multiples compress significantly. And what you need to be, make sure that if their balance sheets are in good shape, then they will be the ones which will survive a downturn. And the smaller marginal players will sort of cede market share to them. And when the cycle reverts, they'll see significant expansion, both from a top line perspective, because they'll gain market share. Operating leverage will play out, and EBITDAs will expand, and therefore valuations will also sort of mean revert. A combination of that will lead to a significant creation of alpha. So I think when you're looking at cyclical businesses, you need to make sure where in the cycle you are, where how comfortable you are on book value multiples, and how well managed the balance sheet is, and then therefore you have to sort of wait it out till the cycle reverts. So I think having a strong balance sheet and being a market leader becomes very important when you're looking at some of these cyclical businesses.
Thanks, Ankit. While there are more questions at sectoral level, so as this is already time, so I think I'll just take one last question. Perhaps Vetri can take this. This is a question coming from online participants such as Ajay Irapura, Sandeep Kaul. Is it a time for asset allocation retreat on account of a rise in yield from fixed income space? If yes, what should be the ideal strategy and type of funds to choose by the investors? So perhaps maybe on both on equity and debt side, if you can throw some light, Vetri. Thanks.
Sure. From an asset allocation framework, as I said, when you do a sort of comparison of equities relative to history, most of it, somewhere between expensive to more expensive. When you look relative to bonds, the needle is actually tilting in favor of bonds, and particularly long-term bonds. So we would certainly say it's a good time to review here where your asset allocation is relative to your target. Right. What we are interested is in deviation from target, not the absolute. Because if you are seeing higher value in equities and lower value in bonds because of the way market is behaved, then it's an opportunity to rebalance. As far as fixed income is concerned, I would say, the attractiveness is primarily coming from where the long-term yields are. And if India is able to deliver with the RPC and with the MPC and the government on the same page in terms of fiscal discipline and inflation, then the current long-term bond yields look very attractive. There are multiple ways to participate in that. It could be longer-term roll-down strategies. It could be FMPs with a longer tenure. It could also be looking at some of the opportunities which are now opening up in passive target maturity date funds, because those will sort of automatically mature at that target date. So I think that is where the opportunities are in fixed income. On the equity side, I would say really look at more of the hybrids. Because the hybrids are sort of participating in all asset classes. So you'll get some equity allocation, but you'll also get some fixed income allocation, which may be attractively positioned. So to maybe multi-asset funds among that hybrid category. As far as equities are concerned, as I said, stick with staggered investments. So essentially SIPs or STPs, that's the way to go, because this valuation context is not attractive for making a shift towards equities. It's more favorable towards bonds right now.
Yeah, thanks, Vetri. In fact, I will also take this opportunity to invite the participants to the webinar, which is also scheduled on fixed income space, addressed by Mr. Amandeep Chopra, head fixed income, is scheduled on 14th, 4 p.m. So for any much queries on the fixed income space on the product level or on the markets, participants may feel free to join us there. Invites have been already rolled out, so kindly you can register yourself. And also just a request to the participants here today. So to use the feedback link available on the screen to share your feedback on the topics that are covered today. So that will help us to do better in our upcoming webinars. So with that, I will hand it over back to Vetri for your closing remarks.
Sure. Thank you, Niranjan, as always, for helping put together the presentations that we use today, as well as acting as the host. And Niranjan always does a fabulous job of that. So thanks from all of us. And thanks to everybody for joining us today. Thank you for sending in your questions. Hopefully, some of the topics that I covered, as well as Ankit's coverage of his mid cap and small cap strategy, have provided you with some insight, or at least some thoughts around which you could structure your own investment decisions. So thanks once again for joining us on this monthly Market Insight call. We look forward to seeing you again at our next call in January 2023. So therefore, I'd also like to use this opportunity to wish all of you and your families a very happy new year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.